If you don't know me, my name is Matt Metras. I'm an enrolled agent from Rochester, from Western, the best chapter. This is where you cheer. Yep, thank you. Tim is our new Western chapter representative. My practice specializes in cryptocurrency, taxation, and bookkeeping. We just started, Emily, so we're good. We're good. Exactly. I'm also the co-founder of the Insight Tax Community, which is a online community for tax professionals, along with my neighbor Brad and Tom Gorzinski and Natalie Colati. I do a fair amount of writing for ThinkOutsideTheTaxBox.com. I have been on the Bitcoin Taxes podcast a whole bunch. And my fun fact is that I am no longer a member of my local Board of Education. So for the last 6 years, I've been saying my fun fact is that I serve on my local school board. I am no longer doing that. It's kind of magical how much time frees up when you eliminate a volunteer obligation from your life. It took all of like 8 minutes for Jeff to call and be like, hey, you know, we have openings on the NYSSEA board, but we're taking some time. We're taking some downtime before we get to that. So we're going to talk about NFTs and some weird crypto stuff today. Anybody have clients with NFTs? Okay. Anybody own NFTs themselves? Anybody ever heard of an NFT? Okay. There's still time if you want to go to retirement planning. So we're going to talk about NFTs. So we'll start at the very basics, what an NFT is, right? People have heard of NFTs, right? People have, anybody want to shout out an example of an NFT that they've heard of? Bored Ape. There we go. Bored Ape, CryptoPunks. Some of these are selling for millions of dollars, and you have to ask yourself why, right? We're going to cover that. Why would anyone want to do this? It's effectively a Pokemon card on the internet, right? So we're going to talk about what NFTs are, how they work a little differently from other virtual currencies. So if you were in the tech panel yesterday, we talked about how currencies are fungible, and it really doesn't matter which one you're selling when you're selling it, right? So an NFT is very different. It's a non-fungible token. That's what NFT stands for. We're going to come back to how that works exactly. We're also going to take a look at what the Metaverse is. Anybody ever used a Metaverse? Can anybody even name a Metaverse? Facebook one. Yeah, no, that's fair. Yeah, so there's a whole bunch of different metaverses, Metaverse I don't know what the plural of that's going to be. But they introduce a whole bunch of weird tax complications to what's essentially an online video game. And then we're also going to look at the very, very little amount of substantial, I couldn't think of that word for a second, substantial authority related to crypto and specifically, but also just, you know, how the subset of that would relate to NFTs, of which is even smaller. So I'm sure we're all used to this question at this point, right? Anyone not asking their clients this question on their organizer or whatever intake form you're doing now? Every once in a while, when I teach, someone will say, oh, I don't ask this question because I know a crypto person when I see them. And I'm sure it looks just like this, but it's not always the case, right? I have 70-year-old grandmothers who trade cryptocurrency. So this is a required question. We should all be familiar with it by now. One of the things we've seen in the last few years is that the IRS has changed the terminology from virtual currency to digital assets. And there's two reasons for that. One is that there's actually a code section that defines digital assets at 6045 G3 Cap D. But there's also, the term digital assets is a little more all-encompassing compared to just cryptocurrencies, right? So I have clients who, and I think somebody asked during our tech panel the other day, do you have clients who only use NFTs and not crypto? And that, it happens on occasion, right? Or they only use crypto to get in and out of NFTs, but that's not really where their interest lies. They're really only engaging in NFT type transactions. So this term digital assets is a little more broad than saying virtual currency, which is what they were using before. However, it's still really confusing for people in the crypto community because crypto people don't use this term digital assets, right? So you ask them if they have any digital assets, and they generally say no, even though you're working on their crypto actively. So it's a little bit of a translation game between you know, the IRS and what the terminology our clients use. So We are seeing that the IRS is more consistently, but not 100% still using digital assets. They just last year put out a revenue ruling. Emily. Yeah, that's a great question that Emily asked, and I'll repeat it for the recording, is if crypto people don't use the term digital assets, if you ask them that 1040 question in your organizer, they're probably going to say no. So I put things in parentheses. I say, did you receive, as a reward, award, whatever the language is, any digital assets? And then I put parentheses, crypto, NFTs, Metaverse, et cetera. There's no harm in asking for additional information. Getting your clients to read it or fill out the organizer, that's a whole different story. But yeah, that can be, giving even more examples like, are you using Coinbase? Do you have MetaMask? Do you have a ledger? Like those are, you can get the problem is there's so many platforms people can be on. They're like, oh, I don't have Coinbase, I have Binance, I don't have to worry about this. So you can kind of pigeonhole yourself there. But yeah, any more detail you can add to that to get the right answer is just helping you and the client. Now there's a quick sidebar that over the summer, the Treasury Inspector General released a report chastising the IRS for not actually doing anything with this data. So they've been asking this question for 5 years now, and the Treasury Inspector General said, well, there should be an increase in audit activity related to crypto based on the answer in this question, and there isn't one. And the IRS is like, well, they don't really know what they're doing with this question yet. So they're building this database. It seems like, for the time being, their goal is to have it in their back pocket, right? You get an exam for some other reason, they find your crypto, you didn't check yes, now all of a sudden you've committed perjury on your return on top of everything else. So there's not really any consequences to checking yes when you shouldn't have checked yes. Like if you're on the fence, like, oh, I bought crypto and didn't sell it, do I check yes? There's no real consequences to that. Very worst case scenario, and we've not seen this happen, you might get a CP 2000. But if you check no when you should have checked yes, you could be in a world of hurt. So I generally, if we're ever on the fence, encourage clients to check yes. Sorry, I got to be pointing this right at the computer to get the slide to advance. So this is basically the entire world of digital asset substantial authority and non-substantial. This is literally all the guidance we've ever gotten on crypto from the IRS. So on the right, on the left, it's on the right in my brain because I'm facing the other way, is all the substantial authority. So that's going to be positions that we can take to rely on to avoid accuracy-related penalties. So you'll see most of these are notices and revenue rulings. They're what we call sub-regulatory guidance. So they're not even, quote unquote, the law. They're the IRS's interpretation of the law or Treasury's interpretations of the law. And sometimes it's important to remember that IRS and Treasury are not the same thing. They're two parts of the same bureaucracy, but sometimes there's some disagreement between the two on how to treat things. So we have our revenue rulings, we have that one code section that I just mentioned, and we're going to spend a little bit of time on the final regulations. So full disclosure, when I started writing this class, these final regulations had not come out yet. So I had to cut some material to make space for them because they're really important and timely. So we're going to spend the first 10 minutes or so on the final regs after we just get through a couple definitions here. So this is the only code section that we have related to anything crypto, and that's 6045 G3 Cap D, and it defines a digital asset as except otherwise provided by the Secretary. However, that's never happened, so you can strike that whole first clause. We don't have to worry about it. The term digital asset means any digital representation of value which is stored on a cryptographically secured distributed ledger or any similar technology as specified by the Secretary. So the Secretary has not specified any similar technology, so we can ignore that last bit too. We only want to look at the middle. And that's clear as day, right? Cryptographically secured digital ledger. So what differentiates a digital asset from a cryptocurrency from like Venmo, right? Anybody have Venmo, Cash App, PayPal? Those are all digital assets, right? They're digital representations of value. But they're not cryptographically secured, and they're not on a distributed ledger. So when we talk about cryptographically secured, it means we're using cryptography to protect the network. PayPal, Venmo, they have security, sure, but who knows what it is, right? It's not going to apply to this. And the more important piece is it's a centralized ledger. So PayPal is the only one who has a record of who has how much money in their PayPal account, right? I can't see how much money Jeremy has, how much Josh has, how much Tim has in their PayPal accounts. With a distributed ledger, everybody gets to keep a copy. Everyone who wants a copy of the Bitcoin blockchain ledger can download it to their computer. It takes up gigs and gigs and gigs, and it takes a lot of time to keep it updated, but you can do that if you want to. And that's the difference. It's the distribution of the network among multiple parties that makes something fall into this particular code section. And so your PayPals, your Venmos are not digital assets in the eyes of the tax law. Has everybody seen the draft of the new 1099 DA? Has anybody seen the draft? Is anybody aware of the 1099 DA requirement? So back in 2021, believe it or not, it seems like a million years ago, as part of the Bipartisan Infrastructure and Innovation Act, one of the pay-fors in that bill was trying to close the crypto tax gap with this new form called 1099 DA. So Treasury and IRS noticed that there's probably people underreporting their crypto, right, compared to other industries because there is no 1099 reporting. That's the point of 1099 reporting, is to make sure people are, it's a voluntary system, right? We're voluntarily giving our income information to the IRS when we file our tax return, but the 1099s keep us a little honest, right? Because if you put an amount lower than the 1099 on your tax return, you're gonna get a letter in the mail asking what that's about. So crypto historically has not had any sort of 1099 reporting. And it's one of the reasons is it's really, really hard to do because there's a lot of anonymity in it. But what we've seen historically is that some exchanges, they're worried about their own obligations, so they're voluntarily filing other 1099 forms that exist, like the 1099B or the 1099K or the 1099 miscellaneous, but none of them really work perfectly for crypto. They all have problems. And so now we're getting this new form. And originally, it was supposed to begin 10 months ago. It was supposed to begin January 2023. Obviously, we didn't get there, right? So they've been kicking the can down the road, now it is set to go into effect for tax year 2025. So the first time we'll see this form in action is January 2026. However, I just read an article in Tax Notes earlier this week that Coinbase is pushing to delay it in another year because they say it's going to take them 18 months to implement once the form is finalized. So, you know, that doesn't mean that's going to happen. That doesn't mean they're going to get their way, but there's still industry groups pushing for even further delays and even more revisions to the form. So there's some problems, some technical problems with the law and the way it was passed. We don't have to really get into the details on that because they're working to resolve those. But one of the big problems here is that the then IRS Director of Digital Assets made a statement in an interview and said that this 1099 DA will result in 8.2 billion additional 1099 forms being filed each year. Now, currently, the IRS handles about 5 billion information returns total, 1099s, W-2s, all that jazz. We've all seen that picture from peak pandemic of the cafeteria in Austin that was like just walls of paper, right? Can we imagine that the IRS has the capability to process 8 billion additional information returns per year? No, of course not, right? Especially at the current levels and especially as they currently are continually get their funding attacked, right? It's going to be really ugly if this happens the way that it's supposed to. Fun side note is that the Director of Digital Assets who made this statement is no longer employed by the IRS. I looked her up on LinkedIn. It said she retired in February 2024. But the final regulations that came out this past summer put a footnote in that says, we know that there was an IRS employee that made this statement, and she no longer works for the IRS. They didn't go as far as to say the statement was inaccurate. They just said, we don't agree with it, and she doesn't work for the IRS. So it'll be interesting to see how it goes. We've seen the draft. We're on our third revision of the draft. The most recent one is September of the 1099 DA. And we'll just kind of keep seeing how they have a whole nother year before they actually need to put this into production, right? So there's still time for it to change. We've seen it change a lot from the April version to the August version. The August version to the September version, I couldn't actually find any changes. I compared them side by side, I couldn't find any changes. But there was a new version. This is the important part. The final regs, these came out end of June, it was 5 p.m. on a Friday before 4th of July, they dropped these regs. Really ruined my weekend because I had to spend the rest of the next week reading 400 pages of regulations to be up to speed on this stuff. So we know they're going to begin tax year 2025. The highlights are that they have carved out some special rules for NFTs and some special rules for stablecoins. And so instead of having to report every single NFT transaction, because what we're going to see is a lot of NFTs have very little or no value, you can report in aggregate up to $600 of NFT transactions. If you're under that for the year, you can report it on one form. So that's helpful for the NFT world. Stablecoins have a $10,000 threshold. There's also a couple notices. I'm not saying everybody should go and read the regs, right? But you should at very least read the 2 notices in the revenue procedure that came out with these regs, because they highlight some really important things. There's some delays in implementation around backup withholding. And that's something we've never really thought about, right, with crypto transactions. These regs say that every crypto transaction is subject to backup withholding if you don't have a W-9. And no one's doing that, right? So that's something to keep an eye on. But the most important thing is this revenue procedure 24.-28. So if you have not read that, absolutely read that as soon as possible. If you have any clients with crypto, you need to be up to speed on this. So what the main changes from the regs are is that you now are required to segregate all of your wallets. So if you have 10 wallets, when you sell a digital asset, you can only look at the tokens that are in that wallet for your basis information. Now, currently, all of the crypto tax softwares put everything into the same bucket, right? We've talked about fungibility before. One Bitcoin is the same as another Bitcoin. It really doesn't matter which one you're selling. So this is a real disconnect between the way people actually do things and the IRS. And the way the tax softwares have been doing it is they just look at it universally. Now, we're required starting in 2025 to only look at that individual wallet for gain or loss purposes. And we have to, if your client has 200 wallets, you got to do it 200 separate times. And you got to track the basis as they come in, as things come in and out of that wallet. So it's going to be an epic pain. But what they're also saying is most of the softwares allow you to select your accounting method after the fact, right? So by default, we use first in, first out. But we're allowed to use specific ID. Under the current IRS FAQ, we can use specific ID as long as you have the date the asset was acquired, the basis of the asset, the date the asset was sold, and the fair market value it was sold. That's the exact same information that goes on the 8949 already. So it allows us, and it doesn't say anything about timing. So what we generally do is we look after the end of the year, we optimize for tax purposes, right? We can pick the accounting method that gives the taxpayer the lowest amount of tax. We're not going to be able to do that anymore. So we have to specifically, starting January 1st, we have to specifically identify no later than the date of the sale if we want to use specific ID. Otherwise, we have to use first in, first out. So with these 2 major changes, this revenue procedure that I'm saying everyone needs to read is the IRS is saying, well, these were actually always the rules, even though we didn't tell you those were the rules. These were always the rules, but we're going to give you a safe harbor to fix it. So as long as you follow the procedure in this safe harbor, you are able to just basically reallocate all your basis going into the new system. So you can figure out, okay, well, in wallet A, I have a basis of $1,000, and in wallet B, I have a basis of $10, but it doesn't make sense for what I want to do with crypto to have it that way. You don't have to physically move the coins in your books and records. You can flip-flop the basis and lock it in. However, it has a very, very short window to be done. So you have to get this done by the extended due date of the return, so that'll be October 15th, 2025. That seems fine. Or the earlier of that extended due date, or the taxpayer's first crypto transaction of 2025. So if you have a client who goes on Coinbase January 2nd and sells something, they've lost the opportunity to use this safe harbor. So we need to be communicating this information to our clients now and getting them ready for this to lock it in, because it's a one-time opportunity. And the revenue procedure is very specific in that it says failure to comply with the safe harbor may result in taxes, penalties, and interest. So basically they're going to say if you don't do this, you've always been required to use first in, first out, and you didn't report it correctly on your return. So that's going to leave at least 3 years open. And in a lot of cases, using specific ID has substantially reduced well beyond the thresholds of the substantial understatement penalty. So this could leave 6 years of returns open for clients, for example. Did you have a question, Pete? It's two separate pieces there. So starting January 1st, to use specific ID, the only requirement is you have to contemporaneously identify no later than the date of the sale. Now, there's a catch to that, because there's no way to tell Coinbase which lot I'm selling it, saying, oh, I want to sell tax lot A, when I'm really selling tax lot G or something like that. There's no way to tell Coinbase that yet. The regs highlight that, and they say, it's not our problem that the industry and software doesn't have a mechanism to do this. This is the law. So that one's not super taxpayer friendly. The safe harbor side is the one-time opportunity, and it's not even looking back at historical transactions. It's really just looking at what you have left. You want a list of everything you have left at the end of 2024, and you want to know exactly what the basis is based on what wallet it's in to get ready for this single wallet reporting. That's really what that part's about. Yeah, there's no recording of that. You know, it gets really nuanced because they make several references to Section 6001. So if you're unfamiliar with Section 6001, is that taxpayers are required to maintain adequate books and records. So your taxpayer is supposed to be obviously keeping these in their books and records. I'm sure all of our taxpayers do that, right? Like everyone has perfect records. Oh, I broke my thing. I'm recording this to, in theory, cut up and put on social media, but I never actually get around to doing it. So, but I broke my thing. So, yeah, so there's nowhere you have to send it in to the IRS or anything like that. There's no election you have to make on the return. It just has to be recorded in the books and records. So is there maybe some leeway there if it doesn't happen by January 1st or et cetera? Possibly. Is it worth risking it if you don't have to? Probably not, right? Oh, and I had a whole slide on that. So that's in your handouts too. That's just the details that I just talked about for the revenue procedure. Now let's talk about the fun stuff, NFTs. So this is an example of an NFT. This is a CryptoPunk. Actually just had a client this year buy a CryptoPunk for about $50,000. This one was purchased in 2021 by Visa for $150,000. I'm pretty sure my 12-year-old could have made this in like Microsoft Paint, but I'm not sure this is worth $150,000, but Visa felt it was, and the crypto community felt it was. These are all examples, and what we're going to see is that not all NFTs are pixelated images or mutated apes that are doing humanizing things. We're going to see all different types of NFTs, and that's what we're going to do a deep dive on today. So these are all NFTs in my wallet. I had this pizza that I bought. These two in the middle are what are called Ethereum name service domains, ENS domains. And it's basically like a vanity license plate for your crypto wallet. So instead of someone who wants to pay me crypto having to like put a whole long string of letters and numbers in order to facilitate the transaction, they can just pay Metras.eth. And that, it's just, you know, it's the same way that our license plates are a long string of letters and numbers, they're not super long, but it's the same sort of concept, right? It's just a vanity thing. There's some other random things that I bought for random reasons. That bought one in the bottom corner, another EA from Arizona, drew on her iPad while we were at a conference, and I was like, oh, you should turn that into an NFT, and I'll buy it from you, and she did, and so I bought the NFT. It was her first NFT. So the only actual IRS guidance we have on NFTs comes from this notice, which is 2023-27. And the only real helpful part of this notice is the definition of NFT itself. So this notice, if you look at the full notice, says the IRS intends to issue guidance about NFTs and the collectible rate. They've not actually done that. They've just said we're intending to issue further guidance. They've never done anything else with it. And in it, they say we're going to use this look-through analysis to look at the asset underneath the NFT to decide if it's a collectible or not. But we have this very, very long definition of what an NFT is. And so we're going to kind of break that down to get a better understanding of what an NFT actually is. So an NFT is a unique digital identifier that is recorded using distributed ledger technology, so that ties back to that code section, and may be used, so this is a may, the may is doing a lot of work here, to certify authenticity and ownership of an associated right or asset. So generally, the idea behind an NFT is it's representative of something else, right? When I buy the Bored Ape NFT, it's just a JPEG, right? It's just an image. Anybody can right-click and save that image and have the same image, right? What the NFT is doing is not saying I have exclusive rights to this image. It's not a copyright. It's saying, according to this blockchain, Matt is the owner of that token. That's really all it's doing at the end of the day. And it only works because the users of that blockchain respect the ownership of the token. People outside the NFT or outside of the crypto world, they don't care if they want that image on their desktop, their phone, or whatever, they just download it, right? It's not a copyright protection or anything like that. We can also see NFTs being used for like ticket events. So crypto conferences are real big on like having NFT tickets, right? So I pay $1,000 to go to a conference, they send me an NFT, and that NFT is my ability to get into the door. And if I can't go, I can resell it to Jeremy, maybe for $900, maybe for $2,000. Maybe I can make a profit on it, right? That's the idea. It's a transferable token. It almost works the same way a ticket does, right? I got a Ticketmaster. I went to the Bills game last weekend. I can transfer those tickets to somebody if I can't go to the game. It works effectively the same way, but it's recorded on the blockchain so everybody can see who owns the NFT, or at least which wallet owns the NFT. So we talked a little bit about fungibility, right? I have $5 in each of my pockets. Those are different physical pieces of paper. They have different serial numbers on them, but they're both worth $5, right? They're mutually interchangeable. I owe Josh $5 for this iced tea that he grabbed me before the class. He doesn't care which of those two $5 bills I give him, right? It's probably $7 plus tip plus gas. Can I pay you in an NFT? But at the end of the day, let's say it's $10 now. I have to give them both now. But it doesn't matter which one's which. That's fungibility, and that's how most crypto tokens work. But NFTs are not generally fungible. There's some exceptions. We might get into that if we have time. But in reality, no two NFTs are exactly the same, right? So the Bored Ape Yacht Club, which is a very famous NFT release, there's lots of Bored Apes. There's thousands of Bored Apes. But each one, A, has an individual unique token number. So there's only one Bored Ape 7321. There's a 7322, 7323, et cetera. But they're all each individuals. The images are different on some of them. There's some overlap. They may look similar. And they're almost fungible in a way that people owning a Bored Ape is really the big thing, right? It's not which Bored Ape you have. So that's an NFT that gets released in a collection. Some NFTs are just a singular one-off type thing, and where you don't have that larger collection for more than one person to own. So we covered the unique part. We've made it through 2 words of this definition. So we'll keep moving on. We briefly touched this on distributed ledgers, right? So the idea behind a distributed ledger is that everyone can have a copy who wants a copy. So you see that on the right. That's what a distributed ledger looks like. A transaction takes place. I pay Josh $10. Everybody here writes it down on their ledger. But at the end of the day, it's no different than QuickBooks, right? QuickBooks is just a ledger where we're recording transactions. We can use the old school, ledger books that are on paper, like Christmas Carol style, right? So I couldn't remember it for a second. We're too early. It's still Halloween time. It's just everyone being able to have a copy of the ledger. Whereas a centralized ledger, now we're a little bit more into the QuickBooks territory, right? So I have a tax practice. I'm recording my transactions on QuickBooks. You all can't just look that up on the internet. You can't see what my P&L is without having my permission, right? That's a centralized ledger that only I have. Now, if I put that out on the blockchain, everyone can see how much money I've made. Everyone can see my crypto wallet. I've put my address up here multiple times. You could pull that up on the blockchain. You could see exactly how much crypto I have in my wallet. If you were in the workshop, the crypto workshop, yesterday, we pulled up my wallet. We basically did my own taxes, right? So we could see how much crypto. I think it was $11,400 in that one wallet. But everyone who wants to can see that. And that's the huge difference between a distributed ledger and a centralized ledger. Does that make sense? So we're also talking about tokens, right? We talked about fungibility, but what is the token aspect of it? And it really is the definition of a token, right? It's something that represents something else. So my token is representing my ownership of the Bored Ape, because it's not a physical thing I can own, but we can tokenize all sorts of other things. We can tokenize that attendance, the entry ticket to a conference, right? We could tokenize, I'm going to push OPR for this, we can tokenize our CE. We can all have our wallets, and you can get an NFT after the class that records your 2 hours of CE onto the blockchain. Any other tax pro or any other taxpayer could look up, make sure you've done your CE for the year. IRS could look it up too, right? It's not ever going to happen, but it's a cool idea, right? When we use this in academia, you know, who's ever had to pay for college transcripts, right? And they're not cheap, you know, and they got to come in that certified envelope. This, in theory, could eliminate that, right? All of your college records are on the blockchain. You just send them your blockchain address, and it's there. So there's cool use cases that are in their infancy. We're not at that point, right? But really, a token is just representing something else. So here's one of the NFTs that I own, that piece of pizza. If you don't know, I'm a big fan of pizza. I have multiple pizza tattoos. That's the other fun fact. So this is rare pizza. This is an NFT put out by an organization called Pizza DAO, and unfortunately, we won't have time to get into DAOs today, but they're super fun as well. So this is token number 1748. So I own this NFT. You can see there is the contract. That's the smart contract that runs the NFT. And you can see that on this date, 53 days after I took the screenshot, or before I took the screenshot, it was sent to one of my addresses, cryptotaxpro.eth. So that is the blockchain record. Anybody who goes out to the blockchain and either looks up Rare Pizza 1748 or looks up this transaction hash, which is the unique identifier of the transaction, will see that the current owner of this NFT is cryptotaxpro.eth. They don't know that that's me unless I've advertised that somewhere, right? Like that's on my Twitter. And if I don't have that vanity plate, it will just have my regular address, which is like 0x53, whatever. So there's some pseudo-anonymity to this, right? So we know exactly what wallet owns these transactions, but we don't know necessarily who's tied to those wallets. And that's one of the things that the IRS struggles with as well. So we've basically covered the idea here, and the May, like I said, is doing a lot of heavy lifting here because it doesn't have to certify ownership. It doesn't have to do anything. It can really just be for funsies, right? There's that NFT that was a loaf of bread I bought for the sole reason to put as my Twitter profile picture to make fun of the guy who's now, for the second time, suing the IRS over staking. If you've been to classes with me before, we've probably talked about Joshua Jarrett, who is a taxpayer who's sued the IRS once to get staking declared to not be income, lost, and now he's doing it again for the subsequent tax year. And he thinks that staking is the same as a loaf of bread. So it was just a little inside Twitter joke that I paid $8 for to get the NFT, right? That was a complete waste of money. I tried to sell it. I'm still stuck with it. I couldn't get anybody to buy it even for $1. So we're using the blockchain as the way to certify ownership of these things. I talked about that a little bit already in that you can always look up who has the asset just by looking it up on chain. The NFT itself is not the image. It's really just this string of computer code, right? And it's going to vary from NFT to NFT. And this is one of the things where it's important to remember that when the IRS is issuing guidance on this, that is not the end of the line, right? That's not the final station on this train track. Every single one of these crypto things, and one of the main reasons the IRS is so hesitant to issue guidance is because these things are all eventually going to go to court, right? And the courts will decide if the IRS's interpretation of the law was accurate. And the law is pretty ambiguous on this, right? And now we're in our post-Chevron era, so who knows how that's going to factor in, right? Everybody familiar with the Chevron deference case? So Chevron deference was a Supreme Court case that basically said when it comes to uncertain areas of law, so Congress writes the law, right? They pass the law, they pass the statute, and then they leave it up to the federal agencies to administer. So a lot of times, IRS included, federal agencies have to kind of figure out what Congress meant when they wrote the law. and they put out regulations. And that's why we have so many more Treasury regulations than we do have code sections, because it's up to the Treasury to interpret what the Congress was trying to do when they passed this law. And historically, since Chevron, which happened, I don't know, in the 80s, whenever something has gone to court, the courts deferred to the federal regulators, because they say these federal regulators are experts in their field, right? Congress isn't an expert at polluting clean water, right? So when Congress passes a bill to protect clean water, they leave it up to the EPA to figure out exactly how to do that and how that works. So this recent Supreme Court case that just came down this summer called Loper-Bright said courts don't have to do that anymore. They don't have to defer to the federal agency. So it weakens all of our federal regulations in the IRS, out of the IRS, everywhere on the federal level. So it'll be interesting to see how that plays out as these things get challenged in court. I mentioned it doesn't have to just be pictures, right? So we talked about the event tickets. We talked about academic transcripts. One of the areas I love to talk about is real estate, right? So there's this idea that you can take a piece of property, a piece of real estate, and tokenize it, turn it into a singular NFT, turn it into multiple NFTs. Say I want to have a commercial building, and instead of coming up with all the money to buy a $20 million building myself, I can break it up into 20 million different NFTs and sell them for $1 a piece, right? And I own a fractional share in this building. It's going to destroy my taxes, obviously, but the concept is amazing. I love to mess with Natalie Colati, who we had at this conference last year, because she hates everything related to crypto. And I'm like, what about tokenized real estate? And she gets mad. But there are no cases of this actually having happened in the United States yet. However, of the final regs that came out in June, there was 12 actual regulations that came out of those 400 pages. One of them is specific to real estate NFTs and 1099 filing. IRS is spending a lot of time worrying about this, even though it's something that has not actually happened, and it's probably illegal in most states. On the right here, this is a CPA I know, and he created this NFT that was redeemable for tax prep. So you bought the NFT to secure a spot in his practice, and you could redeem that for like $1,000 worth of tax prep or something. As we can see, he managed to sell 12 of them. So it's not a super popular concept, but it is something that exists. So now we've pretty much figured out what an NFT is, at least according to the IRS. We're going to talk a little bit about how they function, how they work. So as I mentioned, these are all effectively pieces of computer code. They're called smart contracts. And you can write the code to do pretty much whatever you want. So you can put in a provision in an NFT, a piece of art that you create, that if you were to subsequently sell it, so I create the NFT, I'm the creator, I wrote the smart contract, I created the image, and I sell it for $500. But let's say I'm super popular, right, and my art is now worth thousands of dollars. Well, I miss out on those secondary sales, right? I sold it for $500. The person who bought it from me sells it for $5,000. I don't see any of that. You can code into the NFT basically a residual, a royalty. So you could set it up so any subsequent sale of the NFT, 10% automatically goes, or 20 or 30 or whatever you want to code in there, goes to the original creator. So in that scenario, the second person sells it for $5,000. 500 automatically goes to me as the creator without having to do anything. It's just automated on the blockchain. So there's a lot of cool creator protections that can exist within the smart contract. When it comes to the tax treatment, it's effectively the same as any other crypto. Anybody on tax Twitter? Just the front row here. So there's a very prominent, recently referred to as legendary member of tax Twitter who's Josh is cringing a little bit, who's an attorney out of New York City named Matt Foreman. And he loves, I've been taking his tweets and turning them into NFTs as like a troll thing, like as just a way to mess with him. And sometimes, I actually sold one of them for $75, so that was pretty exciting. Are you going to post that on Twitter right now? So he also is not a fan of S-Corps, so that's a whole different story. But that's what that tweet is about. But really, when it comes down to it, NFTs work the same way as any other crypto. So if you were in yesterday's session, we went through that whole workflow of how to categorize transactions, how to record transactions. As long as the NFT has a name that you're going to figure out what it is, then you're fine. As long as it's got the same name when you buy it and when you sell it in your software, that's fine. It's going to have that same information. There was a date you acquired it. There was a date you sold it. There was a purchase price. There was a sales price, right? That's the information we need for the 8949. So we don't treat these any different than we would any other type of transaction that way. However, we really need to make sure that the software, and if you did come to yesterday's session, I spent a lot of time talking about how software is not a magic fix for this, right? Every software gets stuff wrong. So here we have the exact same NFT, which is this one, another one of Foreman's tweets about sales tax. We'll come back to sales tax. That's a whole different issue. And here's how 5 different softwares pulled this transaction. This first one gave it a fair market value of 0. This one didn't assign anything at all. This one, like, we can see it didn't even pull the same amount of Ethereum each time, which was the counter side of this transaction, right? So when we especially get into things that are not widely traded, every software is going to pull those off the blockchain in its own unique way, which may or may not be accurate. So if you have clients with NFTs, we got to spend some time reviewing the software. You can see that this one at least threw an error that we're missing the purchase price. You can see it even calls it different things. This one was Xerion. It says it's called NFT symbol. I had a client earlier this year, unfortunately very late in extension season, right? So I have clients who do their own crypto calculations, right? They use the software, they're comfortable doing that. I go in and check and make sure everything's tied out, and I go in there and I say, hey, you have 3,000 different NFTs all labeled as NFT symbol and all dumped into the same bucket for basis purposes. That's not correct. And he's like, well, there's no way I can fix that. And I was like, well, you better at least figure out the 12 you sold, what the basis are. So we got to be really careful how the software is recording these. Yeah, so that's a really good question, and it's why would the name of the NFT change? Because the name is almost arbitrary, right? It exists technically on the blockchain. It exists as open store 3944198 blah, 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 blah. You can see that that's a 3-line identifier, right? This software pulled it in as NFT symbol. This software pulled it in as the name I gave it, Foreman on NFTs. I put that in the NFT as I created it. So it really just depends on how the software works. But if you're just trying to look it up, open store 3944 blah, 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 is going to be a lot harder to know what we're talking about. So some softwares do it some ways versus the other. We've not seen any guidance, but NFT transactions are probably subject to sales tax. And that's all we're going to say about that. So if you have clients, I hate sales tax. I never want to touch sales tax. New York is not even a pain in the ass sales tax state, but I just don't want to deal with it, right? If you have clients selling NFTs, make sure they're aware that they potentially have a sales tax requirement there. And that's going to vary from state to state, but it's almost certainly subject to sales tax in New York as a digital product. So we're going to do a little case study. We're going to take a look at an actual NFT and figure out what the tax treatment on it here is. So this is an NFT called the Financiers, and it was created by a gentleman named Dave Pollitt. He is from Rochester. He and I met 21 years ago selling QuickBooks on the phone. So if you think you hate Intuit, I've had a long sordid history with Intuit, selling QuickBooks on the phone in 2003. But he became an NFT artist. I became a crypto tax guy, so it's kind of funny. So he created this NFT called the Financiers, and he created 50 of them. He sold them directly on his website for $377 a piece. So that part is pretty straightforward, right? He sells this. We're going to look only at this singular NFT, which is number 40 out of 50. He sold it for $377. He's got $377 of income, right? That's really straightforward. Now, there is a secondary seller, and his name is Lord of Bongo, I'm assuming he plays the bongo drums, who has this listed on OpenSea, which is basically like an eBay for NFTs. And he was selling it for 4.3 Ethereum, which at the time was worth $14,359. So he's making a ton of money on this Dave Pollitt. So Dave, we're going to assume he's Schedule C. that he has $377 in gross revenue there from the sale of this NFT, right? He's a Schedule C, so he has potential deductions. That could be he paints on canvas and then scans the canvas, so he has physical prints of these as well. So he's got his painting supplies. He's probably got a space that he's using for painting that he rents. He's got, you know, his administrative costs and all that. Also has, and this is not gas for your car, right? So when we engage in a cryptocurrency transaction, there's fees associated with it that we call gas. So that's just the fee to move some crypto from one place to another place, and they can add up. Ethereum gas fees can get really, really expensive. So that part was really easy, right? So Lord of Bongo, let's say he sells it. I don't think he actually did end up selling it because I took the screenshots while it was for sale. But let's say he sold it for that $14,360. He had a basis because we know he bought it from Dave for $377, right? So he has a basis, he has a cost basis in it. And it's the same capital gain or loss, right? He held it for investment. He paid $32 in tax, but also there was a 10% royalty built in. So Dave protected himself. This guy's selling his work that he put all the effort into for 14 grand, and he only made $377 out of it. 10% royalty built in, 1436 goes back to Dave. So that's going to be an adjustment to sale for Lord of Bongo. So we're going to subtract out the basis, the gas, the royalty to get to a net short-term gain of $12,515. So it's basically the same as any other property sale, right? When we break it down into its component structure, it's actually really easy. We can see that this is a short-term sale because long-term is going to be a whole different ball. We're going to get to that in a second. In this same transaction, Dave has generated $1,436 of additional self-employment income. So, oh gosh. So this is why the last transaction was short-term, right? So what is the difference between selling short-term appreciated property and long-term appreciated property? That if the long-term appreciated property is a collectible, then it's subject to the 28% collectibles rate. This is an NFT of Tom Gorzinski. So there's some backstory to this. Tom was doing a webinar for Compass, I think, and he said something about waving a red flag, and then a whole bunch of red flags mysteriously showed up at his house, and for once it wasn't me. I think it was Matt Gaylor who sent it to him, who's another enrolled agent in Phoenix. And so then he was at Tax Summit, I think it was last summer, doing a presentation on stage, and he pulled out the red flag. Josh took a video of it. I stole the video from Josh, turned it into an NFT. I was talking about it here last year, and I had been trying to sell it. I was trying to sell it to Cheryl Travato in exchange for a Compass, which if you subscribe to that, it's like $1,000, and she was not on board with that. I tried, though. I tried to sell it to Tom for a Compass, too. He wouldn't take it either. But I ran into Cheryl on the Thruway rest stop on the way home, and we were talking about this NFT, and I was like, Cheryl, if you can set up an Ethereum wallet, I will gift you this NFT. I will just send it to you. And she did. She managed to do it. It was kind of calling my bluff, right? I was like, Cheryl's not going to set up an Ethereum wallet. But she sends me a message on Facebook, and she says, here's my Ethereum wallet. I send her the NFT. So now Cheryl owns this NFT. Her basis in it is my basis because it's a gift, which I just recently did my own taxes a week ago. And my basis was $3. So I let her know that her inherited basis is $3 in this Tom NFT. So she might be willing to sell it to you. But the reason we look at the collectibles rate is that Section 408M2, which has to do with IRAs, it has nothing to do with capital gain or loss or long-term gains, says you can't hold collectibles within an IRA. And then it goes on to define what a collectible is. And this has been an unanswered question in the crypto world. Is a Bored Ape a collectible? So we look at the code itself, and it says any work of art. Okay, so that's a maybe. Is a Bored Ape a work of art? Any rug or antique or metal or gem or stamp or coin or alcoholic beverage or tangible personal property. So we know it's none of those things. It could be a work of art. Art is not defined in the tax code, in the regs. We see cases about art, but it's not in this context, right? We see mostly about people who are trying to get giant deductions for art that wasn't worth what it was worth. So we kind of have to answer that question. We get this notice from the IRS last year, 2023-27. And this is the same notice that had that definition of NFT in it. But it also said that we're using this look-through analysis. And it says, if the NFT, because they're recognizing, one of the arguments made before, was that the NFT can't be a collectible because it's a computer program. It's a string of computer code. It's not actually the object. It's not actually the Bored Ape. It's just a token representing that. So the IRS says, well, we think that if we look through the asset to what the token points to, if that's a collectible, then NFTs are subject to the collectibles rate. Now, that said, this is a notice that said we intend to issue guidance that says, and then they never issued any subsequent guidance. But you can probably assume that if it came down to it on exam, this is the position that they're going to take. So feedback period on that closed back in 2023. Oh, I think this one actually references Josh. That is probably an NFT as well. So that's a fun full circle. I talked about fractionalizing, right? We can take that commercial building and we can break it down into smaller units and sell those as small units. Now there's a whole different non-tax related problem about selling unregistered securities, and the SEC is going to be all over that. But that's not our problem as tax professionals at the moment. We can see someone took a CryptoPunk. CryptoPunk was that one that Visa bought for $150,000 and broke it into $1 per share. So you can say, oh, I own a portion of a CryptoPunk, right? So we also see charitable organizations that will take crypto and NFTs, which is fine, not a big deal. However, has anyone had a client who has donated stocks to a charity? So if you have that situation, if you were in Marty's class yesterday, he talked about how you want to donate the appreciated ones because you get to take a Schedule A deduction of the higher of your basis or fair market value at the time of the deduction. So if you have a super low basis and it's super high fair market value, you can just donate that, sidestep the capital gains tax, and still get the Schedule A deduction. So that's a huge benefit if you're doing that. With securities specifically, you also don't need a qualified appraisal because you can just use the fair market value on the date and time. We can look up on the stock exchange what the stock was worth, right? In theory, crypto works the same way, right? Because you can look up what the value is. However, that exception for securities is defined in the tax law, in the code. So it doesn't apply to crypto. So even though we can easily look up the value of crypto that we're donating, if it's over $5,000, we still need to get a qualified appraisal. So if you have clients who are doing this, you want to make sure that they're doing that or donating less than that. The other thing is because of these smart contracts, they can do really funky things. Like this one on the right is accepting NFTs, but then you get 30% kicked back to you later on. So you don't get that full deduction, right? We always have to reduce the deduction on Schedule A by any contemporaneous goods and services received. So this might make compliance really difficult because we're not going to know at the time we file the tax return how much money is actually coming back from the deduction. So I would just generally shy away from those. There was a Chief Counsel memorandum in 2023 that just highlighted the fact that, yes, we do need to get a appraisal done if we're doing that. So that's just the reference for that. Also, this one's for you, Josh. How do we value the NFT that we're donating, right? It's easy to look up how much Bitcoin is worth if we're donating Bitcoin. But if we're donating my Matt Foreman tweet, I think it's worth $10 million, right? So how do we not have abuse in that? And someone named Josh Youngblood, enrolled agent, had posted this in the Compass group asking about determining the value, right? There's no great way to do this. There's no place you can just centralized database where you can look up NFTs. But really, the concepts are no different than when we're trying to value any other piece of property, right? We think about real estate. If you're selling your real estate, you're fighting your tax assessment, whatever it is, you can go out and establish comparables, right? You have your agent or whoever go out, find comps, and we can get a rough idea of what the fair market value of our real estate is. It can work the same way with NFTs, right? If it's part of a collection, the collection will always have something called a floor price, which is like the lowest price an individual unit in that collection has sold for recently. So that can be helpful. Sometimes you just got to, be a little creative there. So it can be super complicated. If it's under $5,000, we can look at Pub 561. Again, pubs are not substantial authority, but they give us some idea of what we can look at. So if it's under $5,000, we can use the actual liquidation value. If I sell it, if I donate it to the charity turns around and immediately sells it. That one's pretty straightforward, figuring out what it was worth. We can look at the comparable sales. We can take a high-low average of units that are similar that have sold over the last year, whatever time period is reasonable. And then if it's over $5,000, we're still required to get that appraisal. That's going to help us determine that fair market value. But now we're just pushing the hard work off on the appraiser to figure out what it's worth. So we're seeing NFTs go more and more mainstream, right? Starbucks had an NFT-based reward program called Odyssey. Now, this is separate from the regular stars you get from going to Starbucks, and they've sunset Odyssey recently, but they were doing that for a while. They were recording your rewards to the blockchain. Macy's, for the last couple of years, has airdropped NFTs during the Thanksgiving Day parade to people who were able to fill out their form fast enough. We're seeing them on Reddit, on Instagram. The one that really, really scares me, though, is that Sony has filed patents for NFT technology on the PlayStation. And if your minor dependents are able to engage in taxable transactions without knowing it while they're playing their PS5, that's going to be really problematic, right? So in the current rule set, and who knows what it's going to look like by the time those actually come to market, but that's something that keeps me up at night. A whole subset of the NFT world is NFT gaming, or what we call GameFi. So we have that DeFi, GameFi, it's just a play on words there. So these are games that use NFT assets as sort of the fundamental building blocks of the game, right? So I play Legend of Zelda on my Switch, right? I pick up a sword off the ground. That is not a taxable event for me, right? It's what they call a closed loop system. There's no way for me to sell it outside of the game. Here in DeFi Kingdoms, I pick up a sword off the ground. That is potentially a taxable event for me, because I can take that sword and I can sell it outside of DeFi Kingdoms. I can sell it for not a lot of money probably, but I can definitely sell it, and it exists outside of the universe of the game. It exists on a blockchain that allows me to move my assets from game to game. So I get this really cool sword in game A. I can now move it over to game B and use it there as well. So that's the idea behind why these things are on the blockchain in the first place. This is a game called DeFi Kingdoms. It's somehow one of the more popular ones, despite its 1987 graphics. And it's based on these hero NFTs. Question? Yeah, so the general rule of thumb, and the question for the recording was these games where you have to buy packages, like think about Fortnite, and you have to buy V-Bucks to buy anything in their store. And League of Legends. Those are generally not transferable outside of the game. And that's the differentiating factor. So if you buy V-Bucks and they only exist in the Fortnite universe, it's not a taxable transaction. You don't have to report anything. But if you buy some sort of game currency that you can send outside of the game or sell outside of the game, then it all of a sudden becomes a taxable transaction. Okay. The IRS briefly had a whole thing on their website back in 2019 about virtual currency and convertible virtual currency and differentiated the two. And they've kind of backed off on that, but that was a big hot button issue for a little while. So these are all heroes that I own in DeFi Kingdoms. They're all independent NFTs, which is fine. It's easy to track the date that I got them and what I paid for them, right? I had a client who came to me, I think probably 2 or 3 years ago now, had $600,000 tied up in this game, and sent me this report, sent me this spreadsheet that was like, oh yeah, I've been to the tavern, and I went farming, and I was on a quest, and the spreadsheet was just like, quest, 1 bloater fish, and a date. And I was like, well, how the hell do I figure this out? So I went and I took my own money, threw it into this game, and started playing to see what the reports looked like, right? So now I know, oh, I went on a fishing quest, and the bloater fish is a fish that I caught. And the fair market value of that bloater fish was like 4 cents. Okay, that's great. That's probably not reportable. One time I went on a quest, I got a golden egg that was worth $200. So that is ordinary income to me at the based on the fair market value at the time of receipt, right? That $200 becomes my basis when I sell it, when I eventually sold it for like $4, because that's how these things work. But we have these NFTs. What's going to get tricky is that we can level up these NFTs. And those are going to be adjustments to our basis, right? We have to adjust our basis. It's not a disposition. We're not selling the NFT or anything, but it's going to become the same way if we have a rental property and we put a new roof on the house, right? We adjust our basis, we start depreciating the roof, whatever, but we keep that in our records, and that's going to work the same way for NFT. So we're having almost effectively fixed asset schedules for these video games. So we can level these up. You can see this one is level 5. It has various skills based on that level, and it has experience of 84 out of 6,000. So when it gets to 6,000, I can level it up to level 6. The stronger they get, the better they get at their jobs. We can buy and sell our NFTs, our heroes. That's pretty straightforward. But we can also rent them out. I can take my heroes, I can leave them at the tavern. You know, maybe I got a level 10 or something, right? Something that other people want to use because of its strength. I can leave them at the tavern. They pay me a fee to rent my NFT. They use it for a while, bring it back. So that's going to be ordinary income. There's some unanswered questions there about, does this go on Schedule E? I don't know. Probably. But, you know, I don't, as long as you report it, I don't think anyone's going to care too much. Because honestly, what we're seeing, right? And I've handled a fair amount of crypto exams. What we're seeing is that the revenue agents have no clue what any of this stuff is. So they don't want to deal with it either. So as long as it's reported, we got the income on there, we're going to move on to something else. I had a client who had $54 million worth of crypto transactions. The agent was only focusing on $1,000 of unreported bank account interest. And I was like, dude, take this and run. I don't think it's accurate. I don't think that was actually income to you, but just take it and run, because we don't want to go deep dive into this crypto. So generally speaking, income from these games is going to be ordinary income, because Section 61 effectively says all gains or accessions to wealth are income unless something else in the code says they are not. So the default treatment is, if you are in a better position today than you were yesterday, that's an accession to wealth. That's income under Section 61. Ordinary income, if we can't find a spot for it, you know, we said, oh, does this belong on Schedule E? Is it interest? Does it go on Schedule B? Schedule 1, just put it on there, right? Unless we're in the trade or business of playing this video game, which we're probably not, but it's possible. We can do all of the DeFi things. If you've ever taken a DeFi class with me, we talk about all these crazy transactions that people would not ever engage in traditional finance, but they can easily do it in the crypto world. A lot of these games, like DeFi Kingdoms, is really just a DeFi exchange with a game skin on top of it, right? You're still conducting the same transactions you would on any DeFi exchange here in the crypto world. If anybody knows Jason Stats, who's a YouTuber, he and I did a video a while ago to see how many taxable transactions I could come up with in the course of 20 minutes playing this video game. And I think we actually lost count. We got into the 30s and it got really complicated. And then we actually, you can create new NFTs by taking two parent NFTs and having an NFT offspring, basically. So we did that for this video, right? So I'm still asking him for the child support related to this. He has not yet come through. But you can see a lot of them are exceptionally small, right? So I went fishing, and I earned $0.001. So this is 1/10 of a penny. Obviously, that's not a problem, right? But there's the potential, if these things have more volume or if I'm doing it at a much higher transaction rate, that they are going to add up to real money. So having $0, okay, I don't really have to worry about it. It's going to round down to 0. We had talked yesterday in our workshop about bridging. I think it was Jeremy's question between bridging and wallet transfers. We don't have good guidance on that, if bridging is taxable or not, but you can actually bridge these NFTs as well and move them from one blockchain to another. So that's just an additional complication that we don't have any guidance on. This is probably the first GameFi game called Axie Infinity. It's now gone defunct, but for a while, people were actually making their living playing this video game. It's very similar, it's a battling game, so you have your NFTs that you collect and build up, and you fight them against each other like Pokemon, effectively. And whoever wins more crypto from the protocol. You put money on you're both basically gambling on it too, right? And other people can gamble on your NFTs. So there was people who were playing this full time. Is that a trader business of DeFi video gaming? Probably. Another thing we just don't have guidance on, right? I have a client who's super, super into this one, and it drives me nuts. This is just straight out crypto gambling, but you buy these NFT horses, and then you race them, and people can bet on them based on their attributes. And he had 35,000 ZRUD transactions last year, and I keep explaining, and this guy, I only do his crypto reconciliation, and then he has somebody else who's doing the return, and I'm like, you need to make sure your preparer understands that this is gambling income and expense, right? This is not just capital gain. So we're wagering on these transactions. That one's called ZRUN. Pegasus is a similar horse racing game with better graphics. Hamster Combat. This one's new. So I started playing this in like late August, early September, and it was advertised to have they're going to have the biggest airdrop in history for their players, right? So I spent about an hour a day maybe playing this game, and you're just leveling up your hamsters, basically. And you're able to like buy outfits for them. I bought the Turkish shooter from the Olympics outfit for my hamster. So after about a month of playing, I got my airdrop. Anybody want to guess what the airdrop was worth? So close, $7.65. Yep. Now currently worth $3. Because it's like halved in value. But I have $7.65 of ordinary income that I have to report on next year's Schedule 1. And then as soon as I figure out how to sell my hamster, I'm going to get my $3 back out of this game. Parallel Life is just another collectible card game that you're buying card NFTs and playing them in a Pokemon or Magic the Gathering type style. Upland, you buy virtual real estate, and you collect rent on it from other players. It's almost like online Monopoly, but with real-world addresses. But those properties are all NFTs. So this is back to DeFi Kingdoms, and in 2020, I think this is 2022, I had 951 taxable transactions from this game. And the thing is let's be honest, right? Most people playing this game are not reporting this. I, under the rules of Circular 230, have to report it, right? But, and theoretically, everyone should be reporting it under the tax code. But we can see that I mentioned, like, I got that report from the client that was like, oh, I went questing, I went crafting, I went to the gardens. I didn't know what any of those things meant. But it's really just a translation game. They translate into other types of transactions that we're familiar with. So we have to go from, like, GameFi terms back into regular crypto terms, back into tax terms in order to figure out where they go on the return. NFTs were straightforward, right? Trader was actually capital gains transactions. Liquidity was liquidity pools. Gardens were yield farming. The bank transactions were actually staking. Crafting was capital gains and NFTs. Questing was mostly airdrops. And then the wallet transactions were either bridges or non-taxable wallet transfers. So we had to go through and like figure out what each of these types of transactions meant in order to figure it out. So we're going to take a look at an actual case study of leveling up this NFT, right? So we have Burn Cloud Dream NFT that I own, level 5. And we can see here's all those reports of NFTs, right? So I purchased an NFT here, and they have an ID number. And I paid 39 Joule for that NFT. If you remember yesterday, if you were in the workshop, we were talking about Joule versus Wrap Joule. Like, this was the currency from this game. So, Burn Cloud Dream, that's his ID number. So I took this Excel spreadsheet with all the transactions. I filtered it by ID number, so I have 142126. So these are all the transactions that I've ever conducted with this specific NFT. We're going to see they're all in a pretty short period of time, right? March 2nd, 2022. As you can see, I'm clearly working on tax returns at full speed. I wonder why everything ends up on extension. So we bought Burn on March 2nd, and we leveled him up a couple times. So we see the purchase event here is 38 joules. So that was the cost. So we have to figure out what that 38 joule is worth in order to figure out what our original basis is. Then we had 5 or 6 different level up events. And so the level up required two different actions. It required us to meditate, and then it required us to push a level up button, and those had costs. So to meditate, we needed to spend 1 Shavas rune, and then to level up, we had to spend 0.1 joule. And then as you can see, as you get up into the higher levels, the costs go up as well. So this is just the exact same data that's in this table. It's just a little easier to read. So on March 2nd, we made the original purchase of 38 joule, and then we leveled up a couple times, 4 times, on different dates at different costs. So we have this whole table. We know what happened. To make things simple, we're going to use FIFO, first in, first out, based on all the holdings of the joule and the things like that. Now, under the rules, it doesn't mean we have to use FIFO, but it's going to be a lot easier if we do. So we have to figure out that basis of the joule originally, right? So we used a total of 38 in the first transaction, and then 0.1, 0.2, 0.3, and 0.4, and then a total of 1, 3, 5, 8 Shavas runes. So I had purchased the joule back on 2/26 using a different cryptocurrency called One, which was the native token to the blockchain we were on, 1,430 of those. I bought 39 joule. The fair market value of that at the time was $223. So I take that $223, I divide it by the number of joule I have, I get a basis that each joule is worth $5.71. So one of the things that can get really complicated, right, is I didn't buy this joule with dollars, so I'm tracking it back through the basis of the One, and I got the One for something else, probably Ethereum, and I bought the Ethereum with dollars, right? So you have all these steps in the system that you have to track. So how about the Shavas runes? I didn't buy those on the same date. I bought 2 on March 2nd for $9 effectively by trading another crypto. I took some of that joule and traded it for Shavas runes for $7.96. I got some from a quest. So here I had $7 of fair market value income from the quest. These 2 I got on a quest, and those had $4 of fair market value. So I had a total basis in these 8 runes of $28.03. So now we're just building an additional table, right? So we have our initial purchase. It was 38 joule, which had a fair market value at the time of $212.42. We took that 517 or whatever it was, multiplied it by 38 to get to this fair market value. So we also had, so that makes it our 571 times 38, our basis. So I got too far ahead. The joule was worth at the time of the sale $212, but my basis in it was $216. So I actually had a $4 loss on the date that I bought the NFT. So the joule, 571 times 38 equals $216. I traded it away to get this NFT. At the time, it was worth $212. So I recognized on my return a $4.56 loss, and my NFT now has a basis of $212.42. Then we go to level it up, and now we're just adjusting the basis. So to level it up, I spent 0.1 joule and 1 rune. I had $5.06 worth of basis in it. At the time, those 2 combined were worth 63 cents. So I had a $4, you see the loss is a theme here. $4.43 loss on that. But now I have to take this 63 cents and add it to the basis of my NFT. So the NFT is basically building up its basis as I conduct these transactions. Then we just continue to do that. There's a whole bunch of other transactions. Overall, I lost $23 just buying the level ups to give us a total basis of $227.25. Question? Yeah, so the question was, does it cost me anything when I'm exchanging these? So depending on how we define it, yes, there's almost always transaction fees, but also these are literal assets that I own that I'm spending, so it's almost the same as if I'm spending dollars. So it's costing me assets to barter transaction effectively. So now we have our NFT with an adjusted basis of $227.25. At the time I put this screenshot together, the floor price of these NFTs, which was the most recently lowest sold price, was $2.05. So I have a $225 unrealized capital loss here that I'll be able to sell at some point to offset some gains. I don't pay capital gains taxes, I can tell you that, because I lose too much money trading NFTs here. And that was the easy one, because we had the acquisition dates and information for all those transactions. We didn't have to figure anything else out. So here is a summon transaction, which is effectively creating a new hero. And that costs us 21 Gaia's Tears and 64 Jewel. And then we did some enhancements. But we can see the enhancements here. We used a whole bunch of different things. We had to create these potions, and you have to take all these different in-game assets and dump them into the potion to make the potion. And then your hero drinks the potion, and they level up. However, each of these has their own basis and acquisition date, and we have to figure out. So we're creating NFTs on NFTs on NFTs to figure out what the fair market value and what the capital gains are. Luckily for us, we're not going to do this one as a case study. Keep an eye on the time. You could, yeah, absolutely. So the question, if you didn't hear it, was if this rises to the level of trade or business, could those be COGS? It would, it would really depend on how you're using the assets, but absolutely. Are they really inventory? Right, exactly, exactly. And in a lot of ways, it's a really good question, Jeremy, because we have to, the crypto thing makes it seem super complicated, right? But we have to look through the crypto, just like the IRS in their notice, to what's actually happening underneath. What am I really doing? And what are the fundamental taxation principles that come with that, right? Is this an inventory asset or is it a capital asset? That's going to answer the question of whether it's COGS or not.
Talking about it like work in progress.
Yeah, exactly, exactly. So,
this finished good that we're going to put out that sell.
yeah, it really could be. So it really depends. So we have a little bit of time left. We'll talk about the metaverse. So when we think about the metaverse, I want you to think about a video game mixed with a cryptocurrency mixed with a social network, right? It's all of those things together. It's an immersible world where you can spend crypto assets, but you can engage with other people. You can do all sorts of things. A lot of time it has its own unique economy. Sometimes they're based in like augmented or virtual reality. Sometimes they're just cheesy video game graphics. It really just depends. These are all examples of them. Sandbox, Decentraland, those are the most popular ones. Roblox, Upland, Horizon, there's tons of them. All of my screenshots, I generally, when I use Metaverse stuff, it's in Decentraland, so all of my screenshots are from Decentraland. When I took this screenshot, there was a pride parade happening, so I jumped up on this elephant, took a selfie. But this is what it looks like, right? So that's my avatar in the front with the hoodie and the jeans. And you just wander around the same way you do in a video game. But you can engage in all of these other things. There's events happening. There's gambling happening. You can have, I've seen Zoom meetings take place in the metaverse, right? People put on their virtual reality. You don't have to have virtual reality glasses, but people put on their VR headset and they walk around like they're actually in there, right? There was a very infamous, I guess, accounting firm, Craig or Mattis, that opened up a Decentraland accounting office. They were also the firm that was auditing FTX that went bankrupt, so that didn't work out super well for them. But there's all these things that are happening in the metaverse. Maybe you can find love in the metaverse. There's dating apps inside there. There was a dating.com sponsored blockchain wedding where they're recording the nuptials onto the blockchain. And it was a mass event of 3 different couples that were getting married that day. I didn't remember to log in to see how that went, but you can just play games, right? You can play miniature golf. You can play poker. You can gamble with real crypto money playing poker in the metaverse. So we're adding all these additional layers onto our taxable transactions, but at the end of the day, we're just looking back through it as what actually is happening. We're just gambling and playing poker. Legality of it aside, right, because that's not something that we're asking ourselves, is this a taxable activity? Did I engage in gambling wagers, and does that need to be reported as such? We have companies that are advertising in the metaverse, right? So that's going to be a Section 162 expense, right? Duolingo has their little pop-up bird, annoying bird. Anybody use Duolingo and get the reminders? And it's like, you've been gone for 8 minutes. We really miss you. Come back. So now they can hound you in the metaverse too. Hey, you forgot your daily lesson. Come back to us. You can buy property in the metaverse. It's very, very expensive for reasons I don't understand. But we saw, so this on the left is the Decentraland. These are pieces of property within DeFi kingdoms, and that's the cost in joules. So we saw what my basis in Joule was like $5, I think, right? This piece of property is 500,000 Joule. That is a ton of money for a digital property. I found this one. This was the cheapest piece of property that I could find in Decentraland, and at the time, it cost $4,383 US value. And it's, I mean, I guess you can see the lake. The property isn't lakefront, but I really don't understand the concept of paying this much money, but people are doing it, right? And that's the thing we have to be aware of. Our clients could be doing it. We also have, building on everything we've talked about, NFTs in the metaverse. So, has anyone ever heard of Bitcoin Pizza Day? So, as the story goes, back in, I think it was 2010, the first known transaction with two unrelated parties involving Bitcoin was some guy who posted on a forum and said, I will give 10,000 Bitcoin to whoever can get a pizza delivered to my house right now. So he was in Florida. A gentleman in the UK went online to Papa John's and delivered 2 large pizzas to this guy's house in exchange for 10,000 Bitcoin. At the time, it was like $43 worth of basis. 10,000 Bitcoin now is like $6 million. So assuming that guy doesn't still have them, but that's the first known transaction within Bitcoin among unrelated parties. So every May 22nd, the crypto community celebrates Bitcoin Pizza Day because that was the day that it happened. So I saw this. So we can buy things for our avatars. We saw my avatar riding the elephant. He was wearing jeans and a hoodie, right, and a t-shirt. But I want to spruce him up a little bit. I could buy him a kilt. I could teach him various dance moves. I could teach him how to box for 25 mana. That's the currency that's used on this platform. But I was like, oh, I got to get this guy a piece of pizza, right? We got to have some pizza for him. So this pizza was 3.2 mana when it was for sale. Now, you can see this is red because I didn't have any mana. I didn't have the currency needed to purchase this pizza, so I had to acquire it. You can also see pay with card is an option. However, illegal in New York State makes it more problematic if you're trying to conduct this transaction in New York State, and most of us live in New York State, where generally speaking, New York is the least crypto-friendly state out of all 50 states. We have a lot more restrictions than other states do on who can operate cryptocurrency exchanges or transactions here in New York. So I try to buy some mana because I want to get this pizza mask, right? So I start with the card thing. I'm like, all right, I can go through the card. I get to a point, I don't know who this is, but they want my social security number to buy this Bitcoin pizza mask. You know, I've taken a few of Brad's classes. I think that maybe that's not the best idea to put my social into this random website to buy this pizza. So I give up on this method. I'm like, all right, I'm going to have to do it the crypto way. Might need to involve a VPN, et cetera, so I can get around some of the New York restrictions. But I go to try to convert it. So we go through a bridge transaction. We talked about bridges a couple times and how they work. We're moving assets from one blockchain to another. And I have plenty of mana on the Ethereum blockchain. But to buy this pizza, I need mana on the Polygon or Matic blockchain. It's the same blockchain. They use 2 different names. So I try to do this, and I pay an approval fee of $6. And it ends up not working. It just doesn't work. The system doesn't work, so I've paid $6 fee for nothing to buy this $3 piece of pizza. So I find another way to go through. I find this hop bridge, which is a different type of bridge. And it says, okay, I'm taking Matic tokens, because I originally was trying to just directly bridge the mana from Polygon that I already had. I had mana. I was trying to bridge it to the Matic blockchain and buy my thing and be done with it. Couldn't do that. So I found this hop bridge. Hop bridge will work, but it doesn't bridge mana. I can't take the assets I have on this blockchain and move it to the other one. I have to bridge a different asset, which is Matic. Matic, also known as Polygon, is the native token to the Polygon blockchain. So I need to, that's the only thing they'll bridge. They won't bridge any other assets onto those chains. So I have Matic too, I'm in luck, right? So I have Matic on Ethereum, I'm gonna bridge it to Polygon. So we see that here. So we're going from this network to Polygon, 120 Matic for 118 Matic on the other network. So I'm losing some just in the process. That's gonna be another cost to me or another adjustment to basis. So I get it over there. I end up now trading the 120 Matic, and I actually bridged a little bit less, but I had some there already, for 226 mana. Now remember, this thing only costs 3 mana, but I'm bridging enough that I don't have to do this again, right? This is a huge hassle. I don't want to ever have to do it again. Spoiler alert, I've never bought anything else in the metaverse since this day. So I have all this other mana sitting there, but that's a whole different story. So I'm gonna swap. So the first transaction was a bridge. Now, and we don't know if that bridge was taxable or not. We've talked about that a couple times. This one is a swap. I'm swapping one token for another, 100% taxable, no question about it. So I'm swapping 120 Matic. I'm getting 226 mana. And you can see here's all the transaction data from the blockchain. We don't really need to get into the details of that part. So now, here is on the Metaverse shop, on the Decentraland shop, you can see that this is me, MDM, and that I have 1349 Ethereum mana that I couldn't use, and 226 Polygon mana, which are basically the same token, they're just existing on different blockchains. But I need to be able to use the Polygon one in order to buy this piece of pizza. So I get in there, and this took me about 2 days to finally get it all done, because I do work once in a while. Now my mask costs 5 mana, so the price went up while I was, taking my time here. So, but now I'm able to buy it. You see, I can click the buy button. It's not grayed out anymore. Yay, I got the mask. We're going to take a look at what this actually did to me tax-wise. But now in my assets, you can see that on-chain, I own this Bitcoin pizza mask. You can see what it looks like when my guy walks around with a pizza hanging out of his mouth. I'm pretty sure it's still in his mouth because I don't remember ever taking it out. So let's look at what the tax consequences were of just this one little piece of pizza, right? So I bought the pizza NFT. That could have just been the end of it, right? That could have been a simple transaction, but no, it's super complicated. So to buy the pizza NFT, I had to sell the mana. To buy the mana, I had to sell the Matic. To get the Matic, I had to bridge it from ETH. We don't know if that third one is taxable or not, and we also have the associated fees. So this is just basically a screenshot of all the different transactions that I engaged in on May 24th and May 25th of last year trying to make this happen. And we can see, at least on this tool called Xerion, that it gives us the contemporaneous fair market value, which is going to be helpful in determining our taxes. So this is the table of all of the different taxable transactions we might have engaged with while we were buying this pizza. So we're going to start at the earliest. I bridged from Ethereum blockchain to the Polygon blockchain. We talked in our tech panel yesterday about why this may or may not be a taxable event. We have literally no guidance on this. Really, the only thing we can point to is Section 1001. And the regs in Section 1001 say if you sell an asset and end up with an asset that is substantially dissimilar, you have a taxable event. We don't have a good definition or enough case history to determine is Matic on one blockchain and Matic on the other blockchain, is that substantially dissimilar under Section 1001? We don't have guidance from the IRS. We can't look it up in the code. We just don't know. I will generally talk with the client and say, hey, if we don't report this as taxable, it's a more aggressive position, and here are the potential consequences. If the IRS decides it's taxable next year and the statute is still open, you're going to owe the tax, you're going to owe interest, you're going to owe penalties. We should disclose it. Here's the pros and cons of doing that. If we take a conservative position, You don't ever have to worry about the IRS coming after you, but you're probably going to pay more tax than necessary. So it's a trade-off, right? And every client has their own risk tolerance. Some are terrified of the IRS. Some don't want to have to potentially pay me to deal with a notice, right? There's all these different things that go into effect. Am I going to take an aggressive position over a $5 transfer? Probably not, right? I might, because I would fight it for fun. But most taxpayers are not going to do that. You know, you got to get joy in the job somehow, right? So my basis in the Matic was $50.04. The fair market value at the time of the bridge was the fair market value, I was looking at the wrong column. So if we're treating the bridge as taxable, I have a gain of $55.39. If we're treating the bridge as not taxable, obviously it's not taxable. I don't have any gain at all. However, if we're treating the bridge as taxable, I've effectively stepped up my basis because I'm recognizing the gain on the transaction. So now we got to buy the mana. And so we bought 226 mana with 120 Matic. The fair market value at the time was $105.43. So if my original basis in the Matic was $50, and I treated the bridge as not taxable, now I got to recognize gain at this point. So a lot of times, if you're bridging something to immediately liquidate it anyway, it doesn't matter. It's just a 10-second timing issue. So we're going to see I had a 53.39 gain there, but if I'm waiting to do it now I have a 55.39 gain based on the sale of the Matic for the mana. If I did treat the first one as taxable, I have an 80-cent loss because the timing differences, et cetera. So now I have a whole bunch of mana. I have 226 mana that has a fair market value of $105, which means each mana is worth 46.5 cents. So that's my basis. And I'm buying this pizza mask that costs 5 mana. We multiply that by our 46 cents, right? So that is a basis of $2.33. We don't have any way to determine what the fair market value of the pizza mask is, right? Other than it's 5 mana. And we know that my basis in the 5 mana is $2.33. So that is the comparable fair market value, right? Because we're just, when we only have a transaction where we only know one half of the fair market value, we use that for both halves. So there's no gain or loss on this because I just literally 10 seconds before established the basis, so it didn't fluctuate up and down. So now I have this NFT with a basis of $2.33. I also incurred all of these different fees. One to approve the bridge, one that didn't work, one to approve the bridge that did work, one to actually bridge it, one for the swap, one to approve the mana to buy the NFT, and one for the actual swap. So I spent $31.47 in fees to buy this $2.33 NFT. And I do it for you guys, right? I wouldn't have done this if I weren't teaching a class on it, but when you need the screenshots, you need the screenshots. So is this a 162 expense? I don't know, probably. But so we add these together, the 233 and the 3147, we add them together, and that becomes my total basis in the piece of pizza. When I eventually sell it for 3 cents, I'll have a $33 capital loss. So that brings us almost exactly to time. Happy to answer any questions. My contact information's in the QR code. But otherwise, thank you so much for having me. Always a pleasure to speak for New York because it's our home turf, and we do put on the best conference in the country.